Hello everyone and welcome to the Inside ETF's weekly webinar. Can you replicate private equity returns in a beta product? My name's Matt Hogan and I'm the CEO of Inside ETFs and I'll be your host for today's webinar. I'm really excited about what we're going to talk about today. Private equity managers are cast as masters of the investing universe, conjuring high returns with uniquely low volatility, some of the last saviors of active management. But a few weeks ago, Eric Stafford showed me some new data and new presentation and research suggesting that those private equity returns could be captured at very low cost in a beta product. He's going to walk through that research and I think you'll be blown away with what he reveals about the truth of private equity managers. Eric is the Johnson A. Paulson Professor of Business Administration at Harvard Business School, which he joined in 1999. His investment research focuses on investment management, capital markets, and the financial system, and he has won a number of prizes for having some of the best research in the market, and this is some of the most exciting research I've seen. But before we get to Eric's presentation, we have another short presentation that I'm really excited to hear. Luciano Siracusano is the Chief Investment Strategist for WisdomTree Asset Management and one of the best ETF and index researchers and speakers that we know. He's going to talk about two WisdomTree products, the CBOE S&P 500 Put Right Strategy Fund and CBOE S&P 500 Put Right Index, and talk about how those can help you reach your investment goals. I think given where we are in the market cycle, it's really important to think about alternative, non-traditional, non-straight beta exposures, and this is a product and an index that I personally like very much. So to kick things off, we're going to hand it over to Luciano to take us away, and then we'll bring in Eric after that. Luch, the floor is yours.
Thank you, Matt, and thank you everyone for being on the call today. I'm going to spend just 5 minutes going through a very simple strategy from WisdomTree called the WisdomTree CBOE S&P 500 Put Right Strategy. We have an ETF, PUTW, that tracks this index, and this is an index that CBOE has been calculating in real time now for more than a decade. So the strategy, again, it's in the ETF structure. The ticker is PUTW, and its goal is to get you the performance before fees and expenses of that CBOE S&P 500 Put Right Index. So the fund, PUTW, invests in 1 and 3 month Treasury bills, and it sells or writes S&P 500 index put options, and it writes those options at the money. Those options are European-style options, which means they can only be exercised at maturity. So what the fund owns, in effect, is treasuries, and it collects the premiums on those options that it writes every month. And typically, I say typically all the time, the fund is completely cash collateralized. So that means that we can't write any more options than we can totally cover with the cash in the fund. So there's no leverage involved. Those options are written monthly, and the reason we write them monthly is because we can capture more gross premium over time rather than writing them quarterly or longer. When we write the option, we're typically going to be collecting about 10% of the volatility on the VIX. So an easy way to think about it is if the VIX is at a level of 10, you should be able to get about 1% premium, gross premium every month. And that comes into the fund. So that if the market is moving sideways or up and that option expires worthless, the fund keeps that. And that's the source of return for the fund. It's the premiums it collects plus any interest on the treasuries that it owns. And it's in the 40 Act structure. So it works well within broader portfolios. The fund has a net expense ratio of 38 basis points. Now, what makes the strategy interesting to us is we can go back and take a look at the 10-year returns in real time going back to June of 2007. And what you see here, the put index in gray has gotten you annualized returns of about 6.4% over that period. So it's gotten you 85% of the returns of the S&P 500, but it's been able to do so with just 75% of the volatility. So the vol for that period on the right side you see is about 11.4%. So this is a way to bring down the beta on your U.S. large cap exposure without actually owning equities. You never take possession of the market. You only own treasuries. You're certainly correlated with the equity market, particularly on the downside, but you're not actually getting adding stocks to your portfolio. And in terms of downside capture, if you look at all the down periods, you're typically getting about 60% of the downside movement of the S&P over time. Now, one of the things that people ask us is, well, how do I use this in a portfolio? Well, if you start on the left-hand side and just say, what would have happened if I owned the S&P 500 over that period? That's that diamond on the far right. You can see your return, roughly 7.5%. Your volatility is 15%. Every time you move to the left with a diamond, you're adding 10% now put index exposure. So that if you were to split it and say, I want to be 50% in the put index, 50% in the S&P, your annualized return over that period goes down to about 7%, but your volatility goes down 2 percentage points. So in effect, this is a way to control overall vol in the portfolio. And people say, well, what does it look like in a big drawdown? We took a look at 2008, 2009 when the market collapsed. 100% put index was down about 43% on an annualized basis over the crisis period. S&P was down about 59. So again, if you had paired them together 50-50, you would have gotten about 700 basis points of downside protection. You're still going down, but you're creating relative alpha in a down market. And so we like the idea of pairing the put index or the put right strategy with the S&P 500. This shows you the standardized returns. And I would just make the point here because people ask what happened in 2008. The market was down 37%. The put index was down 27%. And then every year since then, every calendar year since then, the put index has been up between 6 and 12% per year for 9 years in a row. So it's an alternative source of income, tapping into those premiums, and it's a way to reduce volatility in your equity exposure. This should be viewed as a total return product. The income we're collecting only gets distributed annually. It's basically a capital gain on the index contracts. So it's an annual distribution that gets distributed at the end of the year. But it's a total return vehicle that we think has a sleeve and a place in your alternative allocation. So with that, let me turn the call back to Matt. Thank you.
That's a great presentation, Luch. I'll say that WisdomTree has some fantastic research on the put right product. If you Google put right and WisdomTree, you'll get to their page. There are a couple of white papers there that I found particularly enlightening, so I'd encourage that. Luch, just one quick question for you. You talked about how this product performs in a bear market. Is it best suited by a sideways market? Is it best suited by a rising market? Or is it ambivalent between those two?
Well, in our research, we found that it does provide you downside protection in down markets. So we believe it's a source of relative alpha relative to a benchmark. Sideways markets, it typically does well because you're collecting that premium, and options a lot of times will expire worthless in a sideways market. A big up market this year, you're going to give up some of the upside. And I would say anytime the rest of the market is up more than 12% of the year, you're probably likely to lag in that kind of environment. If the market's up between 0 and 10, you have a potential to beat the market, and I would say a moderate up year. So it's a long-term strategy, reduces vol, and we think it makes a lot of sense in a lot of people's portfolios, particularly as you get late in the cycle and you're trying to lower the overall beta of what you're exposed to.
Yeah, that's why I like this presentation right now, because we are where we are in the bull market, and I think these kind of strategies resonate with advisors. So thanks so much for coming on, Luch. And again, if you want to find out more, really great research on the WisdomTree website. You can get through wisdomtree.com, or I just Google WisdomTree and put right, and that gets me directly to the page. So thanks so much. Thanks for coming on. We're now going to turn to another approach to maybe an alternative way to get exposure to the market, talking about replicating private equity returns in a beta product. As I mentioned at the start of this presentation, we've brought on Eric Stafford, who's done some of the foundational research in this space, to talk about that. Eric, welcome to our webinar. I'll let you take it from here.
Thanks very much. I'm going to talk a little bit about some research that I've worked on related to private equity, understanding the returns to private equity that were delivered historically. It's titled Replicating Private Equity. To set the context, I'm going to show you some returns here This is quarterly data going back to 1986 all the way through 2016. And I'm basically putting $1 into an after-fee private equity index as proxied by Cambridge Associates. If you used a different index, you'd find a pretty similar result. That's the solid blue line in this top panel. And then the dotted red line is putting $1 into public equities that have been levered 2 times. The 2 times leverage is chosen to mimic the increase in leverage that leverage buyouts typically add to the corporate balance sheet as a part of that transaction. And you see that wealth is growing at about the same rate in the solid blue line and the dotted red line over this period. But the panel below shows that the risks of the 2 strategies are quite different. The risks of the public market levered, these are drawdowns, so where are you relative to your previous maximum? Twice in this sample, the public equities that have been levered twice have lost about 80% of their value. And in those periods, the private equities lost about 25%. Prior to 2000, private equity really didn't ever lose money, according to the reported returns. And then the final 2 lines in the top panel, the dotted blue lines, are estimates of what must be the pre-fee returns to private equity, because I've added back some fees based on standard contracts for private equity investments. I'm adding back a fixed fee of 1% a year and then 20% performance, either over a 0 hurdle rate or an 8% hurdle rate, which are 8% hurdle rates a more common structure. So you see that the pre-fee returns have been especially impressive over this period. But either way, the risk-adjusted returns of private equity look quite attractive. So this is what I'm interested in understanding, and lots of people are interested in understanding this. And so we typically try to understand what must be going on. We look to the distinctive elements of the private equity investment process and often think that must be the source of the attractive risk return properties. And so there's lots of stories of how private equity can do things that other investors can't do by taking a firm private. So they're able to potentially improve operations, change incentives, allow management to focus on long-term value creation as opposed to catering to the whims of the capital market. Potentially they can secure preferred financing. This paper really begins with the observation that there are also some passive components to the strategy that first principles of finance are going to suggest are important. And we should first, before gaining too much confidence that the stories above are the true source, we should really benchmark according to these passive components. And the things I have in mind are investment selection. So private equity funds don't start with random selection. They actually focus on a few key characteristics, and so we should study what those are and control for that. They tend to hold positions for long periods of time. That's a constraint for the private equity investment process, but it's certainly something you could do on your own. As I mentioned before, they typically double the leverage of the firm, and so that's, again, something we could do on our own. We could use a portfolio margin account, for example. And then because they hold illiquid private stocks, they tend to be somewhat conservative in how the portfolio gets marked. So this slide is describing just a little bit of structure that I'm going to put on the investment process to kind of discipline my thinking about what's going on. And I'm trying to describe the investment process in these first 2 equations. The first equation, really what the investor sees. It's the reported returns net of fees. And the only point I'm trying to highlight here is that the true economic return gets reported based on current estimates of the portfolio value each period, and there might be some sluggishness in how they get reported. Equation 2 is describing what the true economic returns are, and it's highlighting that, because they use leverage, we really have two components to the return. There's the unlevered return that gets magnified through leverage, and then there's essentially a short position in the debt. So when you put $100 into private equity, you're really buying $200 worth of assets and minus $100 of debt. This also makes it clear that a lot of the benefits that we think of as potentially coming from the active management of private equity really accrue to the unlevered private equity return. So this is something we could do passively. The part that we could do passively is the investment selection. We could try to mimic the investment selection of private equity, and I'm going to call that the unlevered replicating strategy. The leverage itself might also be advantage relative to capital markets. I'm going to use portfolio margin to the extent that there are other benefits of the leverage they're able to obtain. That will show up in their return, and it will not show up in my replicating portfolio. This brings us to that F function, how the returns or the portfolio value each period gets reported. The idea is that we're worried that it might be somewhat sluggish, and so I'm going to use a very sluggish reporting scheme called hold-to-maturity accounting, where all transactions occur at market value, but while in between those transactions, and those in between the time I purchase and sell, it will sit at cost, or the initial transaction price. That's a simple, transparent way of mimicking a conservative portfolio marking rule. We can mimic the fee by subtracting off a fixed fee and a performance fee. And then because I have a portfolio of liquid, publicly traded stocks, I'll be able to mark that accurately each period. And then I will also be able to take that return and apply the hold-to-maturity accounting to see how conservatism in marking the portfolio might affect risk and return. So that's the basic idea of the research. The first step is to study the investment selection. So I'm going to collect a sample of publicly traded firms that were taken private by financial buyers. I'm studying this from the early 80s through the mid, 2016. And I'm going to estimate a selection model, which is going to tell me what are the characteristics that are reliable predictors of whether you are selected for buyout. Perhaps not surprisingly, being a relatively small firm is going to be associated with a higher likelihood of being selected. So as measured by either market capitalization or sales. These firms tend to have low EBITDA multiples. So the enterprise value divided by earnings before interest, taxes, and depreciation is kind of a value characteristic that's quite important. Negative net share issuance, again, you could think of this as a value characteristic, but the firms that are selected tend to be repurchasing their shares in recent periods as opposed to issuing new shares. To the extent that management thinks their stock is overvalued, they perhaps are more likely to issue shares. To the extent that management thinks their shares are undervalued, they're more likely to repurchase their shares. And then what I would call modest profitability. So these are not the most profitable firms in each industry, but they tend to be profitable. They have positive profits. So they're somewhere in the middle. Things that I thought might matter that turned out not to. Market beta does not matter. So the average market beta for the firms that are selected is about 1. I thought that perhaps being a low beta stock would increase the likelihood, but it turns out not to. Market leverage doesn't really matter. And then book equity to market equity, which is the academic value characteristic, does not really matter in the presence of the EBITDA multiple. And so that's interesting because that's the academic focus of what value is, and this is suggesting that they're targeting a slightly different kind of value. Table 4 in the paper, which I'm summarizing here, is kind of a standard analysis that we use to evaluate a signal for portfolio construction. And so what we do is we rank stocks on the signal and then form, say quintiles, but some kind of category bucket to form portfolios on to see how returns vary across different magnitudes of the signal. So here the signal is each period, I'm going to estimate that selection model. I'm going to rank stocks on their likelihood of being selected, and I'm going to sort them into quintiles, assign them to a quintile, and form a portfolio. So the first column labeled low is the least likely to be selected. And as we move to the right, the likelihood of being selected for buyout is increasing. The column labeled high, these are the top 20% of all stocks in terms of their likelihood of being selected for buyout. And then the rows are showing different summary statistics for these portfolios. So the first one is the annualized excess return in excess of the 1-month Treasury bill rate. And so you see that the mean return is steadily increasing as we move to the right. So if you're unlikely to be selected, we have a mean return of about 7% a year. As we move to the high category, the mean return in excess of the 1-month Treasury bill is 17.7%. Volatility is pretty much stable across these categories. And then the other rows are various factor models, the intercept from various factor models. And so this is the unearned return, or the alpha. These are monthly regressions. You see in the high column, these are all economically and statistically large. These are in the ballpark of 68 to 105 basis points per month. This suggests that the investment selection of private equity historically has been excellent. They, after controlling for things that we normally think of as important risk factors, especially value factors, they are outperforming those benchmarks pretty significantly. So I'm going to take that idea, that result, and I'm going to add the other elements of the investment process. I'm going to add long holding periods. Those previous portfolios were rebalanced monthly, so I'm going to now hold these for long periods of time. And I'm going to add leverage. So to mimic the private equity investment process, right, so I'm starting with similar types of firms. I'm now going to apply similar amounts of leverage. So I'm going to double the leverage. To mimic that, I'm going to use portfolio leverage of 2 times. To mimic the long holding periods, I'm going to hold these for 4 years. To mimic the fact that they're willing to sell things early if things go well, I'm going to sell out if they've had a high return. And then to just get a sense of how robust this is to a slightly different selection method, I'm going to use a simple screen, which is just the EBITDA multiple. But the PE selected is kind of the full model. So I'll show you both of those. And then I'm going to report the returns with our traditional mark-to-market based on month-end values, and then also through the conservative hold-to-maturity accounting. So this is a summary of that analysis. Again, the period's 1986 to 2016. The first 4 rows here are some capital market portfolios. I've got a portfolio of Treasury bills where each month I just buy a new 1-month Treasury bill. The S&P 500, and then the Cambridge Associates Private Equity Index, both before and after fees. I'm going to show you the geometric and the arithmetic mean return. I think the geometric mean is probably the fairest one to use to compare across these portfolios because the volatilities are so different. But I'll show you both of those. The standard deviation, Sharpe ratio, the drawdown, the CAPM beta, and then the resulting alpha. So over this period, the pre-fee return, the geometric average is about 18%. The after-fee return is about 13.4%. And so that wedge is telling you that the fees are pretty significant. They're in the ballpark of 5% a year. The reported returns have annualized volatility of about 10% a year, whereas the S&P 500 has volatility of about 17% a year. The drawdown, as we saw earlier, is about 25% in 2008. And if you were to estimate the CAPM beta of private equity, you'd find an estimate in the ballpark of 0.4. Below the line are some summaries of the replicating strategy. So similar firms, similar leverage, similar holding periods, and then 2 different portfolio marking schemes. So the mark-to-market is what we think of as the one that's accurately reflecting the risk. The geometric mean for the PE selected replicating strategy is 20% a year. That compares favorably to the 18% pre-fee private equity index. The standard deviation is 37%, whereas the actual reported returns are only 10. The drawdown is minus 91%. CAPM beta is 1.8. The hold to maturity accounting is the exact same portfolio, the exact same trades. I'm going to liquidate it at the end. I start with $1 and I end with the exact same wealth. And so by construction, the geometric mean is identical. It's 20%. The standard deviation, however, is only 7. So we know the true standard deviation from a well-marked portfolio is 37%. But because of the hold to maturity accounting, the measured standard deviation is now 7. The drawdown that we know to be 90% is only 27%. CAPM beta that we measured at 1.8 is 0. And that results in a much larger alpha. So one observation is that these replicating portfolios are incredibly risky. So the market beta is very high, standard deviation's high, the worst drawdown's terrible. Is this reasonable? Well, this is exactly what we would expect from standard theory. We bought stocks that have a market beta of 1. We doubled their exposure with leverage. We are getting portfolio betas that we would expect to be 2 times. 2 times as large or equal to 2. This is also consistent with, the thought experiment of what if I was to sell a private equity holding in February of 2009? What kind of price would I get? Well, not many people were selling, so it's hard to do that. But there's a really interesting article in Forbes about Harvard Management Company trying to do this. And they're getting offers of approximately 10 cents on the dollar, which is pretty consistent with the 90% drawdown. The other thing you could do is think about how are the bonds trading? So the private equities don't trade during the financial crisis, but the bonds that were issued as a consequence of that LBO often did trade. In a sample of about 360 bonds that I was able to track down that have a price both before and during the financial crisis, the average drawdown for the bonds is about 35%. Since the equity is a residual claim on those same assets, it must be riskier. It seems implausible that the true drawdown is only 25% as the reported returns suggest. And so this graph, I think, summarizes some of the results in one page. So the top left panel, the black line is showing you the after-fee return on the private equity index. So that's what you get as an investor, a diversified investor across private equity funds. The blue line is $1 invested in the replicating strategy. So similar stock, similar leverage, but no fees. We move to the right. I've changed the scale to log scale just to improve the readability. Same data. We move to the bottom left. The black line is the same as before. The blue line is altered, and then I'm removing a fee. I'm removing a 2% fixed fee and a 20% performance fee over an 8% hurdle, which is the standard fee structure. And so you see that wealth is now growing at roughly the same rate in both of these portfolios, but the blue line shows there's much more risk than the black line. And then if we move to the final plot, the same blue and black line, but I've added this green line, which is the unlevered replicating strategy, and no fee. And this is making the point that we know that the green line has half the risk of the blue line because it's unlevered, and we know that the blue line was levered 2 times. This one interpretation of this is that the leverage of private equity is adding risk to the investor in a kind of hidden way because of the conservative portfolio mark. It's also adding return, but the return is not being passed along to the investor. It's being absorbed by the fees. So to summarize, the research suggests that the investment selection of private equity funds historically has been excellent. Publicly traded equities that are matching the characteristics of what they have chosen do very well after controlling for common factors, including value factors in the historical sample. If you take that and add leverage and long holding periods and conservatism in portfolio marking, you're able to reproduce the return distribution of private equity pretty accurately before fees. So this suggests that the active elements that we often think of as being the source of the attractive returns appear not to be. In fact, the passive elements appear to be the source of the attractive returns. And to the extent that the active elements justify the high fees, they actually might be making the investor worse off. Another implication is that we could, in principle, isolate the attractive component, namely the investment selection, and manage this efficiently at low cost with improved liquidity. You could skip the leverage, skip the smoothing, and skip the high fees. And so recently, building on that idea, Summerhaven Index Management has created two indices designed to do exactly that, to try to capture that private equity risk premium by buying similar stocks. And USCF Investments recently launched two ETFs that are going to try to track those indices.
Thank you so much. Like I said, I love this research. It really pulls back the curtain on what's been told to people about private equity returns and showcases exactly how and why that may not be all it was cracked up to be, and how and why it can be replicated using low-cost index strategies. As Eric mentioned, of course, he has partnered with Summerhaven to launch the PE strategy indexes, and USCF has licensed them to launch their buy and buy-N ETFs. Given again where we are in the market and advisors having a hard time differentiating their portfolio from their peers and robos, I think looking at these alternative strategies that capture interesting betas in the market efficiently is definitely worth your while. I did want to thank both Eric and Luciano for coming on today for our weekly webinar. Two great alternative approaches. I think both were worth further investigation. That's why we brought them to you today. Thanks to you, the audience, for joining as well. We hope you can join us again next week at the same time. We're bringing together some of the best economic and investment forecasters we know for a look into where to invest in 2018. For now, this is Matt Hogan, CEO of Inside ETFs. Thanking you for continuing your education on ETF strategies, beta strategies, and new ways to approach the market. We'll talk to you all again next week. Thanks so much.